the 4-year cycle is also uncanny, which I've shown you, and I can put in here. But for October, you can see in the big dashed lines is the pre-election years. And you could point to October 25th area there where you see a low in the Russell, which is today's close. I just posted this out on Twitter a little while ago. But the little dots are the current 23. And interestingly, the pre-election years are, the strongest of the 4-year cycle, as I know you guys both know. October is weaker for the pre-election year, perhaps having something to do with, there being such, handsome gains earlier in the year, that sweet spot that we've spoken about from midterm Q4 to pre-election year Q2. And here we are with, the Russell is most pronounced, 2000 is here, most pronounced with the red dotted line that you're hovering over there. That we're seeing a potential low around October 25th lines up pretty well with all the history. So I know it's a rough day, or a unnerving day, a volatile day, but a lot of times we find lows during these most concerning trading days. So it remains to be seen, but it's still lining up pretty well.
Wow. So I think, yeah, this definitely helps, Jeff. But yeah, so now for all the listeners out there, what we want to do from the IBD perspective is let the market set up. The earliest we could get a follow-through day is next week now, because we reset the count today, and so we're back to essentially day number 0. But if you get that follow-through day, if you start seeing some stocks breaking out, hopefully this, some of this data, will help you get a little bit more conviction to at least take a shot on something on the follow-through day. If something's actually breaking out.
That information into my inbox.
You know what? If you go to if you go to investors.com, usually that information will be on the big picture.
But I used to read the big picture in the paper every day.
Yeah. So it's still on investors.com every day. So
right on the front page on the left.
I love those follow-throughs, and I use Market Smith, but I need to be able to get that confirmation from you guys as well. So I gotta check on that. But
yeah, we'll make sure your subscription is up to date, and we'll give you a tutorial during the break, so you know exactly where to find it. So now you've kind of mentioned how your goal isn't really to get right at the bottom on that bottom day. If you're close, you're like, I'm good. So you mentioned how you don't really have stops in place right now for the indexes. Is there anything about, okay, if this doesn't bottom in October, is it likely to bottom in November? Or how does it play out when October happens and the indexes are still looking for a bottom?
Well, you probably have a situation where there's something more powerful at play. Other forces other than the usual, market forces, seasonal and otherwise. It could be the Middle East. It could be inflation. It could be rates. It could be politics. It could be geopolitics. But here we are in a pre-election year where you generally see the high for a pre-election year at the end of the year and the huge Q4 rally. But if the market can't materialize that, I'm going to start getting concerned. The only things that we don't have stops on are the Dow, S&P, NASDAQ, and Russell 2000 ETFs that are part of the seasonal switching strategies. And, we reserve the right to go in and call a sell if we need to, whether we're at a stop. But right now, it's still playing very much into our hand and very much into our pattern. So while, and I've mentioned my own contrary indicator emotions, and times like these when I'm most nervous have been times when markets have bottomed or turned, when things look darkest. So you got to have a little patience. You got to have yourself a little diversified, other than just being in this trade. But we were out of the market since June 22nd and earlier when we got out of the S&P and Dow. So had we been in the whole time, I'd be even more concerned. But having missed the Q3 correction, I'm okay getting it a little bit early.
Yeah, you saved a lot of pain, and your readers a lot of pain if they were following that for sure,
And
because
even
it
more
was pretty
so
tough.
last year, as you guys remember,
Yep.
right?
Yep.
Yeah.
Exactly.
Yeah.
Getting out of the way of that bear market in '02.
Yeah.
But
Yeah.
here we are, October phobia, bear killer, bargain month, turnaround month, and it's lining up pretty well. If you roll out to the full year chart, I mean, there's a lot of charts we could go through. So this is the S&P for 23 in the purple line, looking at all pre-election years in the black line, first term in the blue line, and pre-election years after a midterm bear market, which we all now agree we had last year. For a while, people didn't agree on that. And then the red line is my aggregate cycle, which includes the all years. I mean, not just pre-election years, all pre-election years, and the third year of the decade, the decennial pattern. So all years, 4-year cycle, decennial pattern. And you can see that in general, there's a late October low. I know they're crossing over a bit. The all pre-election years is most pronounced in that late October low. But there's weakness on all of them. And you can see the seasonal pattern I mentioned in the red line, where you have sort of sideways May to October and up from November through April. And I mean, I'd love to show you the 4-year cycle one again also, but the whole seasonal and 4-year cycle trading pattern continues to track. It's been tracking to a T for quite some time. And as I said, you know, it's times like these when everyone's starting to jump on it that I get a little bit concerned that something might you know, override. But for now, it's still tracking and tracking closely. And this indicates to me, you know, a late October low, potentially a couple of retests or some other pauses at the end of November, and then we take off at the end of the year, the last 2 weeks of the year, especially when small caps outperform. And you know, it's just, it looks pretty on track to me.
Mm-hmm. And you know, you talk a lot. And by the way, we are going to have Jeff back on, like probably February, because you really kind of hit home a lot of times how important the trifecta is for how the year goes. Yeah, the tradition now.
It's the one podcast tradition,
right? But you know, certainly, you know, the first thing you're looking for is that Santa Claus rally as part of your trifecta. So, you know, how important are the next few months in terms of, you know, how we finish out the year to determine what happens next year?
I think they're very important. I mean, if we don't get a Q4 rally in a pre-election year, and then we don't get the Santa Claus rally, which people always mistake as being the year-end rally, where, you know, that's the one Yale invented. If Santa Claus should fail to call, bears may come abroad, and all that little trading period at the end of the year, last 5 days, first 2 of the new year, or the first 5 days of the year, and then the January barometer. If none of that triggers, that's going to change my outlook.
Mm-hmm.
I'm going to need to see those seasonal indicators come in, along with the market behaving more healthy over the next couple of months, for me to continue to be bullish for next year. When the market doesn't behave as it should during a bullish period of time, it's an indication that there are other forces that are more powerful at play. And then when that seasonal bullish period is over, those forces may really have their say. And that's the sort of underlying point about, you know, what happens if the market doesn't rally, you know, in Q4 and doesn't have a January indicator trifecta. You know, I might go bearish. Let's see what's going on in the world. Let's see what's going on with the economy, with GDP and rates, as well as technicals and that sort of thing. But
yeah. And I think that's important, that you always reserve the right to change your mind based on new data. I mean, that's what we have to do, right? Yeah. So talk a little bit about this NASDAQ pre-election year, kind of a similar thing as what you see with the S&P 500?
Very similar, more pronounced. I think that the key thing here is, you know, this mid-July peak, it just really sticks out. I mean, there's a little trade here at the end. I'm sort of pointing at it, you know, at the end of June, into the last 3 days of June, first 9 days of July. We call the Christmas in July, NASDAQ's mid-year rally.
Okay.
Came right on cue this year, and the market peaked as everyone was getting, you know, finally getting on the bullish bandwagon that we jumped on back in last October. And then we had a very typical August correction. There's also this hot July's tendency, which is something that Yale came up with, that we discovered when I was working with them. When you have a hot July market up more 3% or more, you tend to see a low later in the late summer or fall, and we're seeing that right here. We had that sell off, and then we were concerned about some banking surprise, something going on there, but we got plenty of other worries with rates and inflation and what's going on overseas to knock the market down during the seasonally weak, vulnerable period. But NASDAQ here tracking the pre-election year trend in blue, also very similar to the aggregate cycle. And this one has got all years on it, which looks kind of flat on this scale, but you can see the Q3 after mid-July, just sort of flat period. I mean, it's really, you see that October low, between Q3 and Q4, and then a rally to year-end highs